Good morning, everybody. Mike Tedeschi over at Perspective Wealth Planning. In this week's video, we're going to take a look at the four major U.S. indexes. We're going to take a look at gold, which has really started to get going. We'll also check back in with oil. We're going to take a look at the emerging markets, and we're going to jump in and take a look at some speculative data as well. So let's jump right in. Yesterday, the market saw some strong selling, and we'll actually zoom in on an intraday chart of the Nasdaq here in a minute and talk a little bit more about that. But I want to back this chart up and again take a look at this on a daily time frame. Look what the S&P did. Even though the action yesterday was really ugly, all it did was come back down and test this prior breakout zone at about that 3330 level, and then bounce right back up and closed over its 10-day moving average. During the session yesterday, things seemed very ugly, but if you take a step back and look at the bigger picture, yesterday's action wasn't very bothersome. When we take a look at the Dow, it closed underneath the 10-day moving average. And we did break above this 29,400 level that we talked about. We're currently trading back underneath of it. But again, if you look at the candle here for yesterday, not super ominous. Though if you were watching intraday action, again, it felt that way. Here's the Russell. The Russell actually finished green yesterday. So the Nasdaq at one point yesterday was down over 2%. And the Russell turned around and closed green. Can we finally get some performance out of the mid and small caps? We're going to continue to watch that 1720 level and pay very close attention to it. Here's the Nasdaq. Again, the candle at the end of the day doesn't actually look bad. We're still back up over that 10-day moving average. But if we take a look at this in a 15-minute time frame, what I want to show you guys here is that this sell-off undoes a week and a half's worth of gains in a very short period of time. And actually, if we look at this in on a 5-minute chart, we had a 5-minute candle on the Nasdaq that was 1% to the downside yesterday. There's that old saying, stocks take the stairs up and the elevator down, meaning we slowly grind higher, but when everybody wants out, that exit gets very small, and we can see some very large price fluctuations in a very short time frame. And that is what we saw yesterday, and that's kind of the reason I wanted to zoom in on the Nasdaq. For whatever reason, market decided they wanted out of some of the tech names. We did see some rotation into, again, like the Russell ended up green yesterday. But when that happened, I mean, the market really just kind of opened up to the downside very, very quickly. And this didn't take but 20 minutes, and all of a sudden the market was down 2%. So that's the first real warning shot across the bow that I've seen out of the market really in a while. Now, we've had some days where we closed uglier than yesterday, but the velocity of that move in the Nasdaq there in that 20-minute time frame was very large and was a little bit concerning. And so we want to talk about concerning here. Again, you know, the market's up over its 10, its 20, its 50, its 200-day moving average. Those things are good. Look what happened to the RSI in on the Nasdaq here. Fell back underneath that 70 zone. Histogram's kind of turning over, and really, if we were to continue to see weakness right here, it would be a bit of a concern. And when we jump in and we take a look at our sentiment data here from this week, there's a couple of really concerning components. First things first, let's take a look at our smart money, dumb money confidence. We take a look at this on a regular basis. We talked about this a lot as how this would ultimately close that gap and come back down right towards the middle. We have done that, and since then, right, a lot of times you get that crossover, and you see that here and here, i.e., you know, selling continues for a bit, and the market kind of, you know, digests this big move. That's not what's happened here. We came up right towards that kind of middle reading, and subsequently have turned and rocketed back both towards those extremes. So those extremes are still in play. Now, when we start taking a look at what options traders have been doing here over the last couple of months, things start to get really concerning for me. We've mentioned a couple of really, you know, large kind of speculative positions that have happened here, you know, over the last few months. But things are really starting to get to a major extreme. If we take a look here, this is calls bought to open minus puts bought to open over a 6-week sum in million contracts. Look at where we are at. This is a big breakout here from the end of 2019 into this year in terms of speculative bets. All right, the market is placing a ton of speculative bets, more than at any point in history. Another way of looking at this data is taking a look at the total premium paid on calls, right? So people are not just buying more contracts, they're also spending more money, right? People could be going way out of the money and buying, very inexpensive options. That's not what's happening. People are spending more money on options than they ever have in the past. So again, same time frame, breakout at the end of last year into the beginning of this year, and it dwarfs anything else that we have ever seen in history. Now, we looked at that last piece of data, right? The market's always growing in terms of size and participants as populations continue to grow. So more money being spent on options over, as time goes on is going to happen, right? People spend more money on things as time goes on. So another way of taking a look at this data is to look at it as a percentage of the New York Stock Exchange volume. And what you'll see there is it's not at an all-time high, but it almost is, right? Almost 5% of the volume on the New York Stock Exchange is calls bought to open minus put bought to open, and the only time it was ever higher was right there at that dot-com bubble, and we're not talking much higher. We're talking about 0.5% higher than where we're currently at. So when I take a look at this again, we just see rampant speculation going on underneath the surface, and we've just seen the market just grind higher, just rocket higher really from this breakout, and traders are extremely confident that we're going to continue to rock and roll higher. And technically, again, we're above all those moving averages. Look at the S&P 500's action yesterday, right? It came back, it tested a breakout level, it bounced back up. That's a really good technical action. So while underneath the surface, there's a lot of speculation, there's a lot of essentially cause for concern. When we look at the technicals of this market, the market's still ripping higher. It's still holding the key levels that it needs to, and there's no reason to kind of get off of the train, so to speak. But be aware that, and as we saw on the Nasdaq on Thursday, right, when it's time to get off the train, it can happen very, very quickly. So we just need to be cognizant of that. Now, let's take a look in at the emerging markets. We are still hanging around. We've analyze this chart a number of times in these videos for you guys. That key level that we talked about for years was 1100, and price has run into that a number of times and failed. We finally got our breakout. We looked for it to hold that level, fell underneath, fell all the way back to that previous smaller breakout level, that 1050 zone or so, and has bounced back up, and now we are just trading inside this 1100 zone, right? Or a little bit above, a little bit below, a little bit above, a little bit below. What happens here is really important. Just like I think from the mid and small caps, I also look at the emerging markets as the market's ability to kind of take on risk. When the emerging markets and the small caps and mid caps are doing well, people have a higher risk appetite. When those areas of the market continue to lag, that's cause for concern. Doesn't mean, as we've seen, that the market can't continue to go higher. We've had the Nasdaq, the Dow, and the S&P 500 rock and roll higher, while the Russell 2000 continues to not even make new all-time highs. So that divergence can go on for a while, but eventually, at some point in time, one of those is going to tell us the truth, right? The Russell, the mid and small caps and emerging markets are going to play catch up to the rest of the global economy, or the major UX indices are going to play catch up to the mid and small caps. So 1100, still that major key level out of the emerging markets. So we're going to pay attention to. It's right there at that zone. It's right around that 50-day moving average. A decisive close above that and continued push to the upside would be very bullish, especially in the face of what's going on in China. If we could get a move higher out of the emerging markets, that would be very good. Let's take a look in at crude. We talked about crude and that major 50 level in our last video. We only got about a 10% bounce off of that 50 up to 54.5, and that is that short-term resistance zone, and we subsequently have started to pull back down a little bit. But you'll notice what happened after our last video. We closed over that 10-day moving average, and we have held above that. The 10-day moving average is about to cross over the 20-day moving average. That would be good alignment. We still have to get back up over the 50 and the 200, i.e. there's a lot of technical work that needs to be done. But again, when we look at this chart, right, we have a lot of support in there at that 49.50 zone, and the market subsequently went down there. over the last week or so, and has held that zone and started to make it push higher. So if you're watching this, a move like this and then a move higher would be very good. If we were to come all the way back down here and break underneath of it, that would be a very bad signal. Starting to put in the process of bottom, we have to watch how it's going to continue to react down here. What does look fantastic is gold. We have talked a number of times about that. We looked at it on a long-term chart. All right, this is a potential large cup and handle pattern that was set up here on a monthly basis. There's your big cup breakout handle, and has continued to push higher. And this week we finally closed over that 1600 level. Well, the week's not quite over yet, but on a daily basis, it's the first time we closed over 1600 since all the way back in 2013. And if I just clear all the drawings on this chart out and we just put our straight horizontal price action levels in here, this was that major level, and we are now closed up above it, and we don't really have a big level until 1800. So gold looks extremely strong. On a monthly chart, it looks extremely strong. When we take a look at it on a weekly chart, and it looks very strong if we take a look at it on a daily chart as well. So we have that beautiful uptrend breakout that has taken place, and it is doing it in the face of a strong U.S. dollar. The dollar has been strong so far this year. The dollar has been very strong this week. Usually a strong dollar is headwind for gold because gold is priced in dollars. So when dollar is stronger, right, that is a headwind for the price of gold. So the fact that gold is making a breakout while the dollar is pushing higher, that is a good sign for the precious metals space. Guys, I hope you have yourself a fantastic weekend. As always, if you need to get a hold of me, you can reach out directly at mtedeschi@perspectivewealthplanning.com. You can also give us a call at the office at 814-580-9881. We would love to talk to you about anything related to the markets. I hope you guys have yourselves a great week. As always, I'll see you all next week. Take care.